Hello, everyone. In this presentation, I would like to first touch on the economy. Since we're in the middle of November, all eyes are now on the future outlook of the coming year. There is a lot of uncertainty after the COVID-19 pandemic, and new issues are emerging as well, such as the war between Israel and Hamas. Although we do analyze the market conditions and market outlook at the beginning of every month, it is very difficult to have an accurate prediction of what's going to happen next year. Therefore, you can take a look at the following indicators to understand the possible impact of recent events on the air and ocean logistics market. The first indicator is the OECD Composite Leading Indicator that analyzes the short-term market outlook for the next 6 months. As you can see, we have the US, Europe, and China in the graph. Around 25% of the global GDP comes from the US, 17% from China, and 3% from 4 G7 European countries each, making up 12% in total. The three regions take up over 50% of the global GDP, so it is meaningful to look at them for the short-term trends of the global economy. If you look at China first, the figure has been above 100 since April and has been rising by 0.3 to 0.4 per month, showing a bullish market. In the case of Europe, the figure was 99.16, 99.18, to 99.20 down to the second decimal point, from July. Therefore, we can say that the US and Europe are in a recovery phase. Overall, the figures are slowly rebounding from below 100, and China is expanding its market. However, the oil price fell below $80 per barrel due to concerns about China's recession. This shows that the global economy is being affected by China's economic recovery. In the last webinar, the PMI was covered in detail. As I have mentioned, the PMI increased to over 50 because of China's interest rate reduction. However, the figure went back down to 49.5 in October. I'll explain more about this in the following slide. If you look at the US in the graph, the index sharply declined from 49.0 to 46.7. The Wall Street Journal predicted a slight increase to 49.2. This lower-than-expected figure seems to have been impacted by the auto strike in the US. Now that the tentative agreement has been reached, we need to keep an eye on the November US PMI. Next, let's take a closer look at China. There are 5 sub-indices in the PMI, which are new orders, production, employment, supplier deliveries, and inventories. Basically, new orders means demand and production means supply, and both fell down from August, 2 months ago. This appears to be a signal that China doesn't have enough power to recover its economy as of yet. Quick note on the right side, this year's recovery was largely driven by services rather than manufacturing. However, demand for consumer goods started to slow down. Also, external issues such as slowdown in China's real estate market, long-standing US-China conflict and the ongoing war in Ukraine have pulled down demand. On the supply side, one factor was the shutdown of Chinese factories during the National Day holiday in October. Other factors at play include the deteriorating profitability of factories caused by the interest rate hike and sluggish export and import. About the next year's forecast, it will take some time for policy to go into effect, so the manufacturing business will likely recover from the first quarter of next year. But I'd say it will be a moderate recovery considering various risks. For oil prices, as you can see in the slide, there is a cycle of ups and downs. The WTI exceeded $90 in September with the Saudi-Russia oil cuts and war issues, and it broke the $80 mark last week. China's exports were down 6.4% year-over-year in October to $274.8 billion. This may not sound like a big fall compared to -8.8% in August and -6.2% in September, but it's actually a twofold decline from the Reuters forecast of a 3.3% decline. Even though there were reports last week saying Saudi Arabia and Russia would cut oil production by the end of this year, the market is showing a bigger reaction to concerns of China's economic slowdown. This is the U.S. retail ocean import volume data from the Global Port Tracker published by the National Retail Federation, or the NRF. There are two main points here. The first is that monthly import volumes are expected to decrease in the 4Q of this year in October, November, and December. Since the peak holiday season imports have already arrived at U.S. ports, there is a decline in U.S. containerized inbound cargo volume. The second is about next year's forecast. In January, the import volume is expected to be 1.88 million TEUs, up 3.9% year-over-year. In February, the volume is expected to be 1.74 million TEUs, with production down due to the Chinese Lunar New Year holiday, but still up 12.3% year-over-year. Although not shown in the table, there is also a forecast for March next year, which is 1.73 million TEUs, up 6.5% year-over-year. Recently, droughts in the Panama Canal and the Amazon have disrupted container ship traffic in Latin America. The droughts are mainly caused by the El Niño phenomenon. If you look at the ONI index, which can measure El Niño, it was 1.5 in September, which is similar to 1.6 in December 2009. It would be helpful to take a look at the ONI index in relation to ocean transportation. Next, let's move on to the ocean transportation. First, this is our freight forecast in 2024. As of November 3rd, the composite index is at 1068, and we are forecasting a range of 958 to 1007 points for the first quarter of 2024, which is lower than current levels. If we look at the graph by sea lane, the numbers are a little bit different. The U.S. West Coast is forecasted at $1,600, which is down from current levels, whereas the U.S. East Coast is forecasted at $2,600, which is up from current levels. North Europe is expected to remain in line with current spot rates at $797. This is the latest document regarding ocean supply and demand trends published by Clarkson. Estimates for new building deliveries are 2.1 million TEUs this year and 2.5 million TEUs in 2024, which will mark the second consecutive year of large supply growth. Notably, only 130,000 TEUs are expected to be scrapped this year, resulting in a high net supply growth rate of 7.7%. However, in 2024, a record high number of 680,000 TEUs are expected to be scrapped, resulting in a slightly lower supply growth rate of 6.8%. Let's move on to the demand growth. The monthly published Clarkson's forecast first predicted a -1.6% reverse growth in January this year, but the figure changed to 0.3% in July and again to 0% in October, meaning there is virtually no change in volume level from last year. We believe that the revision is caused by the economic downturn in major countries and a slower-than-expected recovery in demand. However, a modest rebound in container demand growth to 3.8% is expected next year. Looking at the SCFI Composite Index, the average value in October was 941, down 1.6% compared to last month. However, it should be noted that freight rates have increased for the past 2 weeks in response to carriers' supply management strategies, with Asia-Middle East and Asia-North Europe routes experiencing larger increases than other routes. Next is Top 10 Container Carrier Trends. The number 1 carrier MSC currently holds a 19.3% market share with a capacity of 5.4 million TEUs. Compared to our January count, when MSC held a 17.4% market share with a capacity of 4.5 million TEUs, there was a drastic increase in capacity in just 10 months. On the other hand, Maersk saw a market share decline from 16.2% and 4.2 million TEUs in January to 14.8% and 4.1 million TEUs today, resulting from the two carriers' significantly different business strategies. Even when looking at the backlog of the new building order book, MSC is at 28.5% and CMA-CGM is at 36.7%, indicating that CMA-CGM is maintaining an aggressive expansion strategy. Accordingly, CMA-CGM will likely overtake Maersk to become the number 2 global carrier in terms of capacity in the near future. Here are some graphs of east-west trade lane capacity by shipping alliance provided by Alpha Liner. First, if you look at Asia-North America capacity, a total of 530,000 TEUs were deployed in October, down 13.6% from October 2022. Reflecting the sustained slowdown in North American demand and resulting slowdown in capacity commitments. The Asia-Europe route recorded 460,000 TEUs in October, up 4.3% year-over-year, reflecting the underlying effects of last year's market disruption caused by the Russia-Ukraine war. Moving on. This is global and main route schedule reliability metrics provided by Sea Intelligence. Global reliability has continued to increase modestly this year, from 52% in January to 64% in September. In particular, we've seen an increase in on-time performance on the west coast of North America, as carriers have been shifting traffic to the west coast due to the ILWU-PMA negotiations and the ongoing Panama Canal issues on the east coast. Accordingly, schedule reliability of carriers has also increased as part of efforts to maintain reliable service to their customers. The average number of delayed days also largely stabilized. For example, 7.7 days were delayed in August 2021 during the COVID-19 pandemic, but now it's down to 4.5 days, similar to pre-pandemic levels in 2019. If we look at the reliability of the major carriers, Maersk remained the most stable at 71%, followed by MSC at 70% and CMA-CGM at 66%, all of which were providing a high level of service compared to 2022. Let's take a look at the container vessel waiting status at the major North American ports. The vessels waiting at the outer port were largely stabilized with 22 vessels at Port of Louisiana and Long Beach, 1 at Port of New York, and 9 at Port of Savannah. The Port of Savannah saw a temporary increase in waiting days due to Hurricane Idalia in August and berth expansion work, but has stabilized since then. This is the global port container throughput status. In the table on the left, ports in Northeast Asia, including Busan, Qingdao, Shanghai, and Ningbo, recorded strong growth compared to September 2022. Driven by improved exports from South Korea and China in the third quarter. The table on the right shows that container throughput is increasing, especially as cargo flows to the west coast of North America due to the settlement of labor negotiations on the west coast and restrictions on the Panama Canal during the shutdown. Now, let me explain some of the key issues by region. In Asia, the Consortia Block Exemption Regulation, known as CBER, will expire in April 2024. As a result, Asian carriers with a large number of slots placed in alliances will be hit harder than their European counterparts. In other words, Asian carriers are expected to have difficulties performing Europe-bound services on their own when alliance operating conditions are adjusted. In North America, the number of daily transits through the Panama Canal will be gradually reduced to 18 in February 2024, due to the worsening drought brought by the El Niño. The Suez Canal Authority has also announced a 15% fee increase, which will result in significant cost increases for routes transiting the Suez Canal. This concludes my explanation on the ocean market for November. Our last agenda is the air transportation. First, let me explain about the TAC index, which is our air freight forecast for 2024. For Hong Kong-US routes, we are forecasting an increase in Q4 2023 during the peak season followed by a downward trend until Q2 2024. For Hong Kong-Europe routes, we are forecasting an increase in Q4 2023 followed by a decline in Q1 2024, but a rebound is expected in Q2. Next is the latest air freight rates through the lens of the TAC index. The main sections of HKG Euro/US, Shanghai Euro/US routes have all seen their average monthly freight rates increase for 3 months in a row. For HKG US and Shanghai US routes, fares have risen back to the $5 range since April and March this year, respectively. VTM to IND routes also saw a fair increase compared to the previous month. Looking at air freight rates, air freights from Asia to Europe/US have continued to rise since September as we enter the traditional peak season for e-commerce and air freight volumes from China. In particular, air freights from Vietnam have risen significantly. Compared to September 11th, air freights to Europe increased by 51.9% and to the US by 42.9% as of November 6, reaching similar levels to those from Hong Kong and Shanghai. Moving on to the next point, this is a report from Seabury on the status of air cargo supply. Global international air cargo supply is mostly weak for Europe in/outbound due to the ongoing war, but is stronger in other regions, showing a 3.5% increase from pre-pandemic levels. While belly supply has slowed as winter approaches, freighter supply is up 3.3% from 2 weeks ago, which is a significant increase during the peak season. This is global international passenger seat trends based on OAG. International passenger seats temporarily exceeded 2019 levels in week 43, but are expected to be at 94 to 100% of 2019 levels for the remainder of November and December. Then, let's take a look at global air freight supply and demand based on IATA data. According to the data, demand continued to remain weak until August 2023 when year-over-year demand increased for the first time in 19 months since February 2022. IATA takes a positive stance for the remaining of 2023 with an improved PMI ahead of the year-end peak season. While not updated in this data, IATA September statistics released last week also showed a year-over-year increase, suggesting that this trend will continue. Next is the data from the Incheon Airport Authority. In October 2023, the Incheon Airport cargo volume reached a 16-month high, up 0.7% from October 2022, as the semiconductor-driven economic slowdown eased. In terms of key regions, Vietnam was down 3% from October 2019, Germany was down 6%, but USA was up 11%. Let's move on to the data from AAPA, the Association of Asia-Pacific Airlines. Passenger markets continued to recover, with demand and supply rising to 81.4% and 80.3% respectively in September compared to the same month in 2019. Cargo demand remained weak in line with the global trends, before posting its first year-over-year increase in September after 19 months since March 2022. Next is the current status of jet fuel and FSC. With the recent decline in international oil prices, jet fuel price and fuel surcharges have also dropped. As of October 2023, jet fuel was down 22% year-over-year, and as of November 2023, fuel surcharges were down 13% year-over-year. Finally, I'd like to cover regional air market trends highlighted in some of the major articles. The first article is that Asiana Airlines Board of Directors recently approved the proposed spin-off of its cargo business, which will be included in the corrective measure that Korean Air will submit to the European Commission. This will increase the likelihood of conditional merger approval from the EU. The second article is that Malaysia's Teleport has announced a mutual expansion partnership with Vietjet to combine their networks. Teleport sees Vietnam as a key market in Southeast Asia with significant growth potential, which is why the partnership was formed. The next article is about Kuehne Nagel opening a new air logistics hub at Paris Airport. Kuehne Nagel noted that the new hub will strengthen its leading position in aviation logistics and its healthcare practice. The final news is the major U.S. airlines report that their cargo revenues fell by a third in the third quarter, but they are optimistic about the fourth quarter and expect to post strong performances. This is the end of my explanation on the air market for November and the entire presentation. Thank you for listening.